This upcoming week is about to be absolutely crazy. We have the CPI, we have PPI, we also have retail sales. So you're going to get a side of the economy, which is likely the most important thing markets are paying attention to in regards to a recession. Retail sales, well, that's not going to look so good every single month heading into recession. So that's going to be very important, but that is on Friday. You do have CPI on Wednesday, and that is going to be the first set of major data that is going to move the markets in a very big way. In my personal opinion, well, you're going to get my opinion here in this video, so stay tuned for that. Also, hit that like button and subscribe to the channel because, hey, why not? It's always a good time to get your financial education on, no matter if it's a weekend, no matter if it's a holiday, your birthday, baby. Slap that ass and don't skip class, baby. So let's get straight into this video. I don't want to waste too much time. The S&P on Friday was down marginally, down 0.08%. It was very volatile back and forth as the markets are trying to figure out, one, where is fair valuations for the markets, meaning what is the S&P 500 earnings going to look like? Well, earnings expectations are still at record highs. So what's really moving the markets as of right now is recession fears as well as inflation fears. And I will say we're in a weird dynamic right now because the markets are fearful of recessions and inflation, but if we go into a recession, well, you can expect to see massive deflation. So inflation would no longer be the concern, but the longer we can go, the better economic data that we get and the higher inflation readings than we get, well, that could mean more and more pain for a longer amount of time, right? A slow and steady bleed down. When we get more recession data, when we actually go into a recession, well, you're going to experience deflation. But then the question is, how bad is a recession going to be? And that's when people will likely start to freak out. And that's when you could see a very violent reaction and a very big move to the downside. So what do we actually have for this upcoming week as far as economic data? Let's go ahead and pull up the economic calendar. By the way, you guys can track this for yourself. tradingeconomics.com/trading calendar, or just trading calendar, and you'll pull up this trading economics. Check it out for yourself. So Monday, you don't have anything. Nothing that's really going to move the markets. You have Fed Williams that speaks. That could be important given we just got the FOMC minutes. And if there is anything new that is said, I doubt there will be, but hey, you got to put it in the video because it's possible. He does speak at 2 p.m. on Monday. On Tuesday, you have Fed Barkin that speaks at 12:30 p.m. You have some data coming out of China, balance of trade for June, exports, imports. Surprisingly or not, that has moved the markets a little bit more over the past couple of weeks is that China data, because when we're talking about a recession, it's not just America, it is the whole world. And that's why the US dollar has been strengthening so much. If you guys go ahead and pull up UUP, you can see this thing is hitting brand new highs. Just on Friday, we hit a new high for the US dollar. And it's the US dollar is strengthening, but it really comes down to the exchange rates between the US dollar and different currencies. So really what is happening is not necessarily the dollar is strengthening, which it is, but global currencies are devaluing as investors are flocking to the US dollar because during times of uncertainty, you want to be in the US dollar. And for comparison, right, we are at levels that we have not seen since back here during the COVID crash. That's a level of uncertainty that is hard to replicate, right? 100-year pandemic. To say that we are at the same levels as that's showing a lot of fear. That's showing a lot of uncertainty. That's showing signs of a recession that is to come, right? So pay very close attention to UUP. That tracks the US dollar, and that is basically telling you the higher this thing goes, the more strength the dollar is getting, aka more weakness the currency is seeing around the world, or global currencies, I should say. So there you have that. But on Tuesday, nothing. Wednesday, you do start to get some more important data. You do have inflation rate year over year, CPI reading, core inflation year over year and month over month, and then the CPI for June. It just, to me, seems like people don't care about the month over month too much. Lately, the markets have really been reacting to that CPI number, just the headline number. And guess what we are expecting this upcoming Wednesday, a new high for inflation, 8.8% year over year for June. Last month we were at 8.6%. There are some analysts and some economists that expect a reading over 9%. If we do get a reading that is 8.8%, 9%, or even possibly higher, well, the markets are going to freak out a bit. At the same time, if we get good economic data, the remainder of this week, or this next upcoming week, I should say, Thursday and Friday, well, things are going to get bad pretty quickly because the markets are going to start to expect this 1% rate hike more and more. And in the last video we went over, there was only a 4% chance of a 1% rate hike. Well, now there's a 7.6% chance of a 1% rate hike. And if CPI comes in 8.8%, economic data comes in good, that is going to give the markets room to price in a 1% rate hike. That is going to tell the Fed, okay, you guys can raise rates by 1%, and that's what they are going to do. And that is ultimately going to cause fear about a recession over the next 6 to 12 months. But it's also going to be, hey, you know, the Fed is going to mess up, and they are going to push us into a very deep recession, one that could take more time to get out of than not. And then the real question is, where is a fair valuation? How much is Apple earnings going to drop? Microsoft, Google, Amazon? And that's a question that takes time to really play out. And that's where you could get a big market reaction to the downside, and then you can start to see a slow and steady move back to the upside. So that's really it for Wednesday. You do have some bond auctions Monday, Tuesday, Wednesday. I don't expect it to do too much. But then on Thursday, you have PPI month over month. This is a key measurement of inflation that the Fed does like to pay attention to as well. Their preferred method is PCE, but PPI is still very, very important. We are expecting a 0.8% or 0.9% rating month over month, I should say, whereas last month we did get a 0.8% month over month increase. So that will be important. 11 a.m. on Thursday as well. You do have Fed Waller that does speak. And that is pretty much it. On Friday, you get the important economic data. And this is where we could potentially solidify that 1% rate hike even this week. And you do have retail sales month over month for June. If this comes in good, if this comes in better than what we expect a 0.5% month over month increase. Last month was 0.8% increase. Even if we can get to 0.8% or potentially 1%, you're going to see that 1% rate hike price into the markets. You're going to see markets expecting that, and you're going to start hearing people talk about that, and the Fed potentially messing up and putting the economy into a very deep recession, and probably, you know, not going to have enough time to realize it, and that's where you get a Fed error, and that's where you get a big problem. Now, Fed Bostic, he does speak at 8:45 in the morning. Like I said, retail sales 8:30 in the morning, and then you do get Michigan Consumer Sentiment preliminary surveys for July, and that comes out at 10 a.m. That will also be very important because we're going to get inflation expectations. We're going to get what people, you know, expect to make over the next coming years, what people expect out of the economy. And what people expect is usually what you end up getting. And what we have been seeing from these surveys is that they have actually been dropping. People are not very enthusiastic about the economy. They think inflation is going to be high for far too long, and it's going to affect how they spend money and how basically their balance sheets are going to look over the next couple of years. So that is going to be very important, and that's really all we have for economic data. Michigan Consumer Sentiment preliminary survey for July, retail sales, which is probably going to be one of the most important data points, PPI, and CPI. On Monday and Tuesday, you don't have anything, so I don't expect a huge move which way or the other. 1-2% up or down for those 2 days, maybe 1% up, 1% down. You know, that's kind of what I expect. I don't really expect these massive, you know, 3% up or down days, but we could start to get those Wednesday, Thursday, and Friday. But Monday and Tuesday, that should be a good time to initiate some trades if that is something that you guys wanted to do. But on another note, you guys also want to pay very close attention to the bond yields, because if recession fears go down, like this says, big payroll gains push recession fears into the corner for now, well, that means bond yields have to go up in a big way. the cost of capital has to go up in a big way. The markets will have to react and price in Fed policy. So if we're expecting a 1% rate hike and the current rate is 1.5 to 1.75%, that means you could be on the higher end range of 2.75%. Well, the 10-year treasury would have to go up in a major way. It would have to go up 50 or 100 basis points. 0.5% or 1% could bring us close to that 4% mark, and that would mean some massive downside for stocks. Trading algorithms are basically trading and pricing stocks off the 10-year treasury. So as the 10-year treasury has been falling, the yield has been falling, while stocks have been rallying over the last couple of days. We could go ahead and actually pull this up and compare the two. Compare TLT. We'll just do that, the 20-year treasury. A little bit different. But if we go ahead and pull this up, well, that's exactly what has been happening. Stock market has been going up, bond yields have been going down, and that is the usual correlation that you will see. Sometimes they pair up, right? Bonds have had a very tough year as well, down more than the actual S&P 500, but as of recently, the markets have been rallying as bond yields have been falling. That is something we should expect to see. But if you want the Econ 101 version of all of that, if that did not make sense, essentially, if the Fed is going to raise rates more and more aggressively, the bond yields have to go up, making the cost of capital more expensive, and the future expectations of what companies will be valued at goes down, meaning the share price will go down because the stock market is a forward-looking instrument and it's always trying to price things in. So now that that is out of the way, let's go ahead and take a look at the S&P 500 as far as the option activity for the end of July throughout August, because July 29th is a date that I'm paying very close attention to. That is a Friday. You get the Fed rate hike July 27th. You do get the advanced estimates for Q2 GDP coming in July 28th. And during that same time period, you do have a lot of large company earnings, right? You'll get Apple, Microsoft, Google, Amazon that same week, right? So you could see a lot of downside pressure in that regard. But I think a lot of people fail to realize options and how big of a role that actually does play. Because you could see all the option activity over the last couple of days has been very bullish. Over the past week, 88% of the total option activity has been bullish. $3.52 billion worth. Almost 22,000 orders on the S&P 500 in the last week. 88% have been positive. Well, that's going to cause a move to the upside. That's going to cause a 6-7% move to the upside like we have seen over the last couple of days. So that is no surprise. But when you look further out on the option chain to July 29th, only 21.5% of the total options that are held in people's accounts are bullish. 78.5% are bearish. So not looking so good the end of July throughout August. And if you guys have watched these videos, well, you probably know that, and well, hopefully you can make some money off of it because it's pretty clear to see at this point. But people also forget, when the stock market just goes up like this, and when you actually have such a large ratio of puts to calls a couple weeks down the line, like say July 29th throughout August, those puts become a lot cheaper. So when people are buying those, you have a very close break even. So it works the same way as a gamma squeeze to the upside in the markets to the downside. So if the markets do go through a negative reaction this upcoming week, well, you could start to see a reverse gamma squeeze where market makers have to short more stock because more puts start to go into the money with a closer break even. So if that all did not make sense, you definitely want to subscribe to the channel and hit that like button so hopefully you can grow your knowledge base along with the rest of us. So there you have that all that information. If you guys want my honest opinion, what I expect for this upcoming week, yes, data is going to be the only thing that is important. I expect Monday and Tuesday to be pretty docile days as long as the Fed Williams on Monday and Fed Barker on Tuesday are chill, which I expect they will be. I don't expect new information, but coming on Wednesday, I think that CPI report is going to freak people out. I think it's probably going to come in at least 8.8 to 9%, and you're probably going to see a pretty big reaction. A 2% down day wouldn't surprise me. You might actually start to recover towards the end of the day. You sometimes have seen that even throughout the last week. You'll be really negative, like on Friday, down over 1.5% on the NASDAQ, ended up closing almost positive. Now, on Thursday, I think PPI will be important. important, and I think it'll potentially add to the fear of CPI as well. And I think you will see bond rates go up in a big way, and I think you will at this point expect to see a 3 to 4% down move in the stock market. But again, you could bounce around a lot. You could go up and down in a pretty big way. And then on Friday, I think that's the dagger in the coffin. I think if retail sales come in good, then I think the markets are really going to freak out, and I think you're going to see inflation fears take over, bond yields go up in an even bigger way. If retail sales come in really bad, I think you might also see the same freak out, because I don't think it's going to be enough for the Fed to change courses. And I think just given what the Fed is doing, 75 basis points pretty much being confirmed for July, if not 1%, if the markets start to price it in, bond yields have to go up either way, and that is going to push down stocks. And then Michigan consumer sentiment, that could just be icing on the cake to solidify a bullish or bearish move. But if you can't tell, I'm pretty bearish over this upcoming week throughout the next couple of weeks. So that is really going to be all for this video. Hit that like button and subscribe to the channel if you guys found value out of this video. Help to push this video out to as many people as possible. Thank you guys for doing that. Get your free stock down below in the description, courtesy of the channel. Free 99, Webull, Moomoo, and Public. Might as well take advantage of that. Thank you guys for doing that. I will see you in the next one.